It was a solid set of results. I think we beat marginally on most of the expectations, and we guided these kind of figures. The driver of growth were a few things. Our balance sheet growth was very solid, both in retail and in corporate for the year. It generated obviously interest income as a result of that, which is pleasing that we saw growth given the pressures we have of marginal sensitivity to rates falling, and we had some Fed cuts obviously in the last quarter of last year, which were feeding through to the balance sheet. That was offset, that pressure, or some pressure in income reduction in terms of growth, was offset pleasingly by fee income, which grew about 11%. And again, we guided that we were focused on that side of the business. Our trade business, we're the leading trade finance bank in Saudi Arabia. We put in some new systems which have made life better for our customers, and we saw really good growth in fee income. Also, our cost management was pleasing. We beat the market expectations on cost growth. We were flat essentially. And we had said that if we saw any pressure coming through on net interest margins, that we're very disciplined. We make sure our investments are yielding good results.
Let's talk about funding costs and margin pressure. We've seen signs of liquidity strains in the Saudi interbank market, and banks are relying more heavily on costlier term deposits. How's this shift affecting SAB's cost of funds and net interest margins, and what's your strategy to manage profitability?
So the expectation around this started 18 months ago. We knew absolutely that interest rates would peak in 23, 24 and would come down as inflation receded post the COVID shock. So what we did was desensitise the balance sheet, and we brought our sensitivity from 12 basis points for every 25 basis points of shift down to close to zero. And we did that through growing the fixed rate side of the balance sheet, through mortgages primarily, but also through our treasury investment book, where we increased the fixed side of that book. The growth in that was 50 billion to 100 billion. So it meant it acted as a hedge, if you like. So the offset of the small sensitivity now we achieve through, as I said before, volume growth in the business, which generates interest income and fees, and have a very strong focus on cost discipline. And in that way, we've said that we can continue to grow profits.
The bank reported a Q-on-Q increase in expected credit losses. Can you walk us through maybe the sectors or the pockets within your loan portfolio that is driving this trend? And does this reflect a more cautious approach to provisioning, or is there really some deterioration in credit quality?
We have historically, in the last few years, had a very low cost of risk. And there's some drivers behind that. But we have a strong discipline around our credit policies, and we're mainly a corporate bank, or 75% of the balance sheet is corporate lending. So you can get movements quarter on quarter, which are single name, one or two names, and not a reflection of a trend in deterioration in any sector. And this was the case in Q2. It's just one or two names, and that's the nature of the corporate business. And so we're not seeing a slowdown. We're not seeing pressure particularly in any sectors yet, but obviously we're watching very closely. The macro environment has become more uncertain, and therefore our focus on risk is essential.
Finally, on capital adequacy, given the evolving regulatory landscape and the steady growth in your loan book, how comfortable is SAB with its current capital buffers? And do you foresee, as we're seeing with other banks in the kingdom, tapping the international debt markets? What are the amounts maybe that you're looking for this year?
We're comfortable with our capital at this point in time, but to continue growing, to your point, we're going to need more capital if we keep growing the balance sheet at 15%, just like the other banks. So yeah, we have guided that we'll be tapping the markets, and what you're seeing is, I think, very positively diversification away from the local currency market into dollars in particular, and we've done that ourselves, and we will do that again. And also, I think what's interesting, I think you'll see a trend now into Asia. As the links between Saudi and the Asian economies grow, and we're seeing that definitely with China and with the rest of Asia, then the liquidity that sits in Asia will, I think, have an interest in being deployed into Saudi bond issuance. So we'll be looking at that market as well as the dollar market.